Good afternoon and welcome to Nasdaq Trade Talks. I'm your host Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Herbert Blank. He's a senior consultant with Global Finesse LLC. And we're going to take a look at using Nasdaq 100 options, or what we call the NDX. It's great to have you with us, Herb. And before we get into the Nasdaq 100, what we call the NDX, you've been in indexing for a while. How has it evolved?
I've been in indexing since 1980 when I was with Fidelity Bank in Philadelphia. And along the way, I even got to meet the people who did the first index fund for Wells Fargo. That would be Mac McCown and Bill Faust, and Jim Burton, great people. And there's nice origins on that first index fund because it used a computer that filled a room this size, had to be kept at 45 degrees, and had to be fed punch cards.
Oh, well, that certainly is interesting. Very different than what we have now. Now, Nasdaq's proprietary index, the Nasdaq 100, the top 100 stocks within the Nasdaq market, ex financials. That's very different than when we first started in 1980, for sure.
Yeah, and it was a great innovation at the time. I remember when John Jacobs and Steve Bloom launched it and put it out there. And it was an overnight success. It was a way to play the tech that was going on there in '99, and it had an unbelievable index return in 1999. Everyone was talking about it. It was very exciting. Then, of course, we had the tech bubble. But it's interesting how robust the Nasdaq index has been 20 years later.
Yeah, well, it certainly has. And while 55% of it is comprised of tech, ex-financial, there are a number of other sectors. These are the strong growers. These are the most innovative companies in the world. These are the stocks that we are trading day in and day out, the heaviest volume stocks. How can investors, financial advisors, even institutions use the Nasdaq 100, the NDX or the NQX to hedge, trade, speculate?
Well, the paper I did, and of course there are a number of ways to get in long only, including of course QQQ and including the NDX options long if you're into options. Specifically, though, for financial advisors that are using QQQ, or even if they're using SPY, what we talked about here is hedging that risk, especially in this environment. You know, fixed income is a lot of advisors are saying about as risky as ever in our lifetimes, in that interest rates can't get much lower. And if interest rates get higher, fixed income funds could lose as much as 20% a year, which is unheard of. That's not why you invest in fixed income, because you're not going to get the income from that stream when it's going down as you had in previous years to nullify to offset the losses.
Right. So why would you use the index versus an ETF? Are there any advantages to that?
On the option side, there are some big advantages.
Right.
And that's what we go through there, and that's why this is such a helpful strategy for financial advisors. You want to be in index options, you really want to be a seller of volatility. Mm-hmm. The reason is 90+% of the time, implied volatility is going to be greater than realized volatility.
Right.
So you get that premium by selling the volatility. So selling the calls makes you a seller of volatility. Now, if you're just selling calls without owning a equity portfolio, that's risky because you can go down that much. But it's called covered calls if you own the equity index or an index that behaves very much like that equity index.
All right. Now you have a research paper that's coming out. Tell us what that's about, and did you find anything interesting in terms of performance? Absolutely.
I believe it was 10 of the 12 years between 2007 and 2019, the Nasdaq 100 outperformed the S&P. And the major reason is the S&P is built to be a mirror of the market. It's not a performance index, it's a gauge, it's a benchmark. And so the S&P 500 has to improve sectors that you wouldn't own for performance, like utilities, like transportation, like banks, like energy. Mm-hmm. So those have been lagging sectors, and that's weighed performance down. If you are investing in an index to diversify your risk, but at the same time focus on performance and not be a stock picker, the Nasdaq 100 is your dream because it's in the stocks of the economy that are best suited to grow, best suited to outperform.
All right, the modern day industrials is what we call it. Thank you so much for joining us at Market Site. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.